Good afternoon, everyone, and thanks for being here. I'm Zach, the Outreach Coordinator here at the Taxpayers Help Center, and today we'll give you a guide to deductible business expenses. The Taxpayers Help Center is a nonprofit 501(c)(3) organization in Northridge, California. We operate two tax clinics. The first is our low-income taxpayer clinic, where we help taxpayers resolve their tax disputes with the IRS. And the second is our volunteer income tax assistance clinic, where we help prepare income taxes for free. And additionally, we are an IRS authorized certifying acceptance agent for individual taxpayer identification number applications. I, Zach, am the outreach coordinator, and Ms. Sue Chotani is the clinic director here at the Taxpayers Help Center. If you would like to ask questions at any time during the presentation, please feel free to email us at info@taxpayershelpcenter.com, and a tax professional will get back to you. So, Taxpayers Help Center helps taxpayers both locally and beyond. And since the services we provide are free, donations are important in supporting us and in helping the reach of our services. Any monetary donations are greatly appreciated, and additionally, those who can volunteer their time, expertise, or spread awareness are a great help. If you would like to make a monetary donation, you may do so at taxpayershelpcenter.com/make-a-donation. Or if you go to taxpayershelpcenter.com and click on the Make a Donation tab, which I've highlighted here in red, um, you may get to that spot on the website to make a donation. And again, anything is greatly appreciated as these donations allow us to do what we do. All right, so today we'll cover the following topics: recognizing common deductible expenses, distinguishing between ordinary, necessary, and capital expenses, keeping thorough receipts and mileage logs for IRS compliance, understanding depreciation rules for equipment and property, avoiding red flags that can trigger an audit, and leveraging record-keeping software to streamline tracking. So before we dive into specific deductions, I want to briefly explain why this topic is so important. First, every dollar you deduct directly reduces your taxable income. This means you pay only tax on the net amount after expenses. So if you earned $100,000 and legitimately deducted $20,000 in business expenses, you're only taxed on $80,000, which is a very big difference. Second, properly categorizing your expenses helps you understand where your money is going and can actually improve your profitability at the end of the year. When expenses are tracked correctly, it becomes easier to identify areas where you may be overspending or where opportunities for cost savings exist. And finally, the IRS pays close attention to business deductions. If your return is ever questioned or audited, having clear documentation and organized records is what protects you. It's not enough to just have the expense. You need to be able to show what it was for and how it relates to the business. So, yeah, as you can see, proper documentation is really sort of your insurance policy in the event of an audit. So now let's define what actually qualifies as a deductible business expense. This point is critical because it guides everything else we'll cover in this presentation. The IRS requires a business expense to be both ordinary and necessary in order for it to be deductible. So ordinary means that the expense is common and accepted in your line of work. Think of it this way. If other businesses in your industry typically incur this kind of cost, it's probably ordinary. So, for example, a marketing agency paying for design software or stock images would clearly be ordinary because most agencies use those tools in their day-to-day operations. Necessary doesn't mean absolutely essential or required to run the business. It simply means the expense is helpful and appropriate. A good test to ask or a good test is to ask is this expense does it make it easier or more efficient for me to operate my business? And if the answer is yes, and it's tied to the business, then the chances are that it's considered necessary. The third piece that's often overlooked is that the expense must be directly related to your business activity. The IRS will disallow deductions that have a personal component unless the business proportion portion is clearly separated. A good example is your cell phone. If you use one phone for both business and personal calls, you need to calculate the percentage of business use and only deduct that portion of the monthly bill. If you don't separate it, the IRS could deny the entire deduction. To give you a few concrete examples of expenses that typically qualify, office rent for the location where you run the business, professional services like your accountant, lawyer, or bookkeeper, software subscriptions such as QuickBooks, Adobe, or CRM tools, basic supplies like printer paper, ink, postage, and stationery. And then we'll go deeper on specific categories like travel, home, office, and vehicles in the next slides. But at this stage, it's important to keep this basic definition in mind because every expense you claim has to meet these criteria. So on this slide, I'd like to highlight a few of the most frequently incurred operational expenses. So these are those that typically arise in the normal course of conducting business. So first, we have office supplies and postage. This includes items such as pens, paper, printer cartridges, file folders, mailing envelopes, and stamps. And while each individual purchase may seem insignificant, they are fully deductible when used for business purposes and often add up over the course of the year. So it is useful to retain receipts and maintain clear documentation to substantiate these expenses. Next is commercial rent and business utilities. If you lease at a dedicated business location, the rent you pay, along with the associated business utilities, including electricity, water, and refuse service, are generally fully deductible. These costs represent fundamental expenses necessary to maintain your place of business. Business communication services are another commonly deductible category. This includes a dedicated business phone line or business internet subscription that is used exclusively for business activities. These services are considered ordinary and necessary in almost every industry today and are usually straightforward to substantiate. Finally, professional and industry-related memberships may also be deducted. Fees or dues paid to trade associations, professional organizations, or businessing networking groups are generally allowable, provided the membership supports or promotes the business in some way. For instance, by providing professional education, networking opportunities, or industry updates. Home office deduction is one of the most valuable, but also one of the most frequently misunderstood business deductions. To qualify, the IRS requires that a portion of the home be used exclusively and regularly for business purposes. Exclusive use means that the space is used only for business and not for any personal activities. Regular use means the space is used consistently, not occasionally or sporadically, for business operations because both of those requirements must be met. Once you establish that the space qualifies, you then have two methods you can use to calculate the deduction. The first is the simplified method, which allows you to deduct $5 per square foot up to a maximum of 300 square feet. The benefits of this method is that it's very easy to apply. There are no allocation of utilities or other costs needed. You can simply just multiply the number of business use square feet by $5. The second option is the actual expense method, which is often more beneficial if you have higher costs. Under this method, you calculate the percentage of the home used for business and apply that percentage to qualified household expenses such as utilities, mortgage, interest, home insurance, and even repairs. So, for example, if your office is 10% of the entire square footage of your home, you may take 10% of those household costs and make those business deductions. Regardless of which method you use, it is important to maintain proper documentation. As I've been saying, this includes keeping a record of the square footage used as the home office, a basic floor plan, or a description of the space, and accurate records of the household expenses that were used to calculate the deduction. So in short, when used properly and supported with documentation, the home office deduction can provide a significant tax benefit for business owners who work from home. So here are the rules governing deductions for business travel and meals, which are two of the most commonly used and heavily scrutinized deduction categories. So let's start with travel. Expenses such as airfare, hotel, accommodations, rental cars, and ground transportation, including taxis, rideshare services, or public transit, are deductible when the travel is undertaken primarily for business purposes. So to qualify, the trip must be necessary for conducting business, such as attending a client meeting, conference, or training. Personal or leisure-related travel costs are not deductible, even if they occur during the same trip, so it is important to separate and document the business portion, clearly. With respect to meals, the IRS currently allows a 50% deduction for meals that are directly related to the active conduct of business. To be deductible, the meal must have a legitimate business purpose, and the discussion must take place either during the meal or immediately before or after. Meals eaten alone or those that are primarily social in nature generally will not qualify unless there is a clear business justification. For both travel and meals, the IRS places a strong emphasis on documentation. So, at a minimum, these records should include the date, the location, the names of the people involved, and a short description of the business purpose. Finally, it is important to note that entertainment expenses such as sporting events, concerts, or recreational outings are generally not deductible, even if business is discussed during the event. The IRS eliminated most entertainment deductions several years ago, and this continues to be a common area of confusion during audits. So, in summary, travel and meals can be valuable deductions, but they must be directly connected to business activities and supported with clear and, um, yeah, just clear documentation to substantiate your deductions. So, there are two methods available for calculating the deduction. The first is the standard mileage rate, and this is for vehicle expenses. So this is the most commonly used, and for 2025, the IRS standard mileage rate is 70 cents per mile. Under this method, you multiply the number of business miles driven by the standard rate. The second method is the actual expense method, which allows the taxpayer to deduct the actual cost of operating the vehicle. This includes fuel, maintenance, repairs, insurance, registration, and vehicle depreciation. Only the portion of those expenses attributable to the business may be deducted. The allocation is based on on a business use percentage. Regardless of which method is used, the IRS requires substantiated records. So this means maintaining a mileage log that includes the date, starting point, destination, number of miles, and business purpose of each trip. Logs created after the fact are generally not acceptable. Also, keep in mind that both methods require an allocation between business and personal use, and only the business use portion is deductible. So, for example, if 65% of the vehicle's total mileage is for business purposes, then only 65% of the actual expenses or 65% of the total mileage when using the standard rate can be claimed. So this slide covers deductions for capital assets, which includes items such as computers, machinery, office furniture, and other equipment that is expected to be used for more than 1 year. Generally, these types of assets must be capitalized and then deducted over time through depreciation. The IRS assigns a specific useful life to different categories of property. For example, computers and office equipment are typically depreciated over 5 years, while certain machinery may have longer or shorter recovery period, However, there are two important provisions that makes allow you to expense the entire cost in the year of purchase. Section 179 allows businesses to immediately deduct the full um, purchase price of qualifying assets up to an annual dollar limit. This election is often beneficial for small businesses that want to recover the cost of equipment quickly. Bonus depreciation is an additional provision that is that allows for a 100% deduction for certain assets in the year they are placed in service. Unlike Section 179, bonus depreciation is not limited to taxable income and can be applied to both new and used property provided it meets the eligibility requirements. If neither Section 179 nor bonus depreciation is used, or if the taxpayer chooses to forego them, the asset will be depreciated over its useful life, with the deduction spread out over multiple tax years. Accurate records of the purchase date, cost, and method of depreciation should always be maintained to support the deduction. Okay, so employee wages and benefits. So all direct forms of compensation, including salaries, hourly wages, bonuses, and commissions, are fully deductible in the year they are paid or accrued, depending on the taxpayer's accounting method. These amounts must be paid for actual services performed by the employee and must be reasonable in relation to the work being done. Excessive or disproportionate compensation may be challenged by the IRS. In addition, any employer-paid payroll taxes associated with those wages, such as the employer portion of Social Security and Medicare, are deductible as ordinary and necessary business expenses. The same treatment applies to employer-paid employee benefits, so this includes contributions the business makes toward health insurance premiums and qualified requirement plans such as 401(k) or simple IRA plans. These contributions are deductible when paid as long as the plan is operated in accordance with IRS rules and is offered in a non-discriminatory manner. It's essential to retain thorough payroll records such as the timesheets, wage statements, and payroll tax filings, along with documentation supporting the term of any benefit plans. These records help substantiate both the amount and the business purpose of the deduction if examined. So this slide covers the treatment of marketing and advertising expenses, which remain fully deductible so long as they are directly related to promoting the business. So this includes digital advertising such as Google Ads and campaigns on social media platforms like Facebook, Instagram, or LinkedIn. And the cost of creating, placing, and managing online ads is deductible in the year incurred. Website-related costs may also be deducted. These include routine expenses such as hosting fees, maintenance costs, and updates to the site's content or design. Large-scale redesign projects may occasionally need to be capitalized depending on the scope, but most day-to-day costs are deductible as advertising or promotion. Traditional materials such as business cards, printed flyers, brochures, and signage used for trade shows are likewise deductible. These are considered ordinary and necessary promotional expenditures for most businesses. Finally, contributions to charitable or community events may be deductible if the primary if the primary purpose is business promotion. So, for example, sponsoring a local event where the business name is displayed on banners or promotional materials is generally treated as an advertising expense. However, contributions made purely for charitable purposes without a promotional element would be treated as charitable contributions, which are subject to separate limitations. So this slide applies specifically to taxpayers who use the accrual method of accounting. Under the accrual method, income is recorded when it is earned, not necessarily when it is received. Excuse me. So as a result, if a customer is billed and fails to pay, the amount may become eligible for a bad debt deduction. So in order to claim the deduction, two things must be demonstrated. First, that the amount was previously included in income. This is why cash basis taxpayers generally cannot take this deduction. They record income only when it is actually received. Second, the taxpayer must show that the debt is wholly or partially uncollectible. The IRS expects to see some reasonable effort to collect the balance before it is written off. This may include emails to the customer, written collection letters, payment reminders, or engagement of a collection agency. Once it becomes clear that the debt will not be recovered, the taxpayer should write off the amount in that tax year. It is important to document both the collection efforts and the basis for concluding the debt, is uncollectible. Without that documentation, the deduction may be disallowed during an audit. Okay, so the first and most fundamental step to maintaining organized and accurate records is to use a separate bank and credit card account for business activity. Keeping business and personal funds separate prevents commingling and makes it much easier for or to identify deductible expenditures. Next, organize receipts and invoices by expense category and date. A consistent system, whether it's physical or digital, ensures that nothing is missed and that each transaction can be tied back to an appropriate business purpose. It is also advisable to retain digital copies of all supporting documents. Storing these documents in a dedicated tax folder or secure cloud drive provides backup in the event that paper copies are lost or damaged. Finally, consider using accounting software such as QuickBooks or Xero. These programs streamline expense tracking, allow you to classify transactions in real time, and generate reports that are extremely helpful when preparing tax returns or providing documentation to the IRS. Strong record keeping not only protects the business, but also helps ensure that you receive full benefit of all allowable deductions. Audit red flags to avoid. The first is large meal or travel deductions that are disproportionate to the overall level of business income. For example, if a business reports $40,000 of gross income but claims $15,000 in meal expenses, the IRS may question whether those expenses are truly business related. It is important to ensure that these deductions are reasonable in relation to the scale of the business. Another red flag is claiming 100% business use of a vehicle, particularly when the vehicle could easily be used for more personal purposes as well. In most cases, the IRS expects at least a small amount of personal use, such as errands or commuting. Unless there is a clearly documented policy restricting personal use of the vehicle, claiming 100% business use may raise questions to the IRS. A similar concern applies to the home office deduction. If a taxpayer claims a deduction but does not actively maintain or actually maintain a dedicated workspace that is used exclusively for the business, the deduction may be disallowed. A portion of a kitchen, living room, or shared space generally does not qualify. Finally, one of the most frequent causes of disallowed deductions is simply inadequate documentation. The IRS requires receipts, invoices, and logs to support deductions. If a taxpayer is unable to produce these records during an audit, the deduction may be denied even if the expense was legitimate. Tax planning tips. First, periodically review expenses, ideally on a quarterly basis. This allows you to identify and record deductible expenditures while they're still fresh and ensures that no items are overlooked. Second, consider the timing of large purchases. If you anticipate purchasing equipment or other capital items that would qualify for Section 179 or bonus depreciation, it may be advantageous to place those items in service before year end in order to claim the deduction in the current tax year. Third, it is always appropriate to consult with a qualified tax professional when there is uncertainty about whether an expense is deductible. And finally, it may be helpful to maintain an annual checklist of commonly overlooked deductions. Reviewing this checklist before filing your return can serve as a simple but effective way to ensure that you have claimed all allowable deductions. So as we close, I want to emphasize three key points. So first, it's essential to understand what the IRS considers an ordinary and necessary expense. Those two terms form the basis of every business deduction. If the expense is common for your industry and genuinely supports the operation of your business, it is very likely deductible provided you can show a clear business purpose. Second, proper documentation is not something that should be done only at tax time. Keeping detailed and organized records throughout the year, receipts, invoices, mileage logs, and supporting notes allows you to capture deductions as they occur and significantly reduce the time and stress of preparing your return. And finally, good record keeping doesn't just satisfy the IRS, it also helps you see where your business money is going, makes year-end planning much more effective, and ensures that you receive the full benefit of every deduction you are entitled to. In short, good documentation protects you and maximizes your tax savings. So that's all for today, and thank you for listening to this presentation. And again, since the services we provide are free, donations are vital for supporting and expanding our efforts. We greatly appreciate monetary contributions. Additionally, if you can volunteer your time, expertise, or share your expertise or help spread awareness, your support is extremely valuable. So if you did have any questions following the presentation, please email us at info@taxpayershelpcenter.com and a tax professional will respond to you. So with that being said, thank you all for listening and have a great day.